Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about NCC Limited, Nagarjuna Construction Company, a strong company in its sector but is going through a difficult time. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Now about NCC Limited, the company is into complete infrastructure solutions. So what do they provide? They provide road infrastructure, rail infrastructure, airports, you can say water irrigation, irrigation facilities, power, etc. Everything is under its ambit. So basically they are into an economic incentive business. They have relatively low debt, but the debt has been increasing, and that is a sort of an alarming factor at the moment. It is a very intensive sector, and the gestation period is high. The economic slowdown has really hurt the company over the last 3 to 4 years. So the numbers at a glance, numbers are not bad, but they're not magnificent compared to other consumer firms or companies if you look around in other sectors. But they are not bad when you compare it with the companies in their own sector. So market cap is of 3,200 crores. The profit dropped significantly, around 20-25% year on year. But one thing is noticeable, that they have a sound profitable. It is a sound profitable company, although the profits are declining. So it is not into losses, or they are not into other companies which are penny stocks at the moment, which were magnificent infrastructure firms in 2003 to 2007 bull run. So one has to take their hats off for that, for this, that NCC has managed their books well, and the numbers are pretty good. That has increased over time, but it's not appreciably high, and they need huge orders to move the needle. Why I have said that? Because they are a 3,000 crore company. They need orders worth at least 500 to 1,000 crores, and when you look at a road and infra company, they are not the market leader. So they are basically, there are many other companies, I cannot name them right now, but there are many companies who bid and get the orders before them. So in order for them to, when their books have expanded so much over the last 4 5 years, for them to make a lot of profit, they need orders worth 400 500 crores at least. So what has been the reasons for the fall in the stock? The infrastructure sector has been under stress. So it is not that it has come out of the slump even after the government has changed in 2014. The problem has been that the government spending has not been of that level that it needed to be in order for the infrastructure sector to pick up. When infrastructure sector doesn't pick up, then you don't get or companies who are lower down the order or lower down the ladder do not get sufficient orders to move their profitability higher. So they are, yes, they are into road, railways, water irrigation, power, etc., and other infrastructure projects. They have some projects running as well, but for them to continuously grow at 20-25%, new orders have to come in, and the order pipeline has to be strong, and most of the orders that would come in would be from the government sector. We don't see the private sector or private capex improving even now. And even in the last 1 month or so after the announcement of the finance minister, even then the corporate sector is very cautious, and many of the people or the managing directors of different consumer companies or other companies which are into you can say capex plans, they are also cautious in order to have their capex plan going. So when capex doesn't pick up on the private sector front as well as in the government sector, then it is very difficult for these companies to do well, because they are the providers for that infrastructure growth. So the economic slowdown has hit this sector badly. This is the biggest downplay, or the biggest sector that has been hurt by the economic slowdown that has taken place, and it doesn't look like that in the next 8 to 10 quarters things would improve, especially in the real estate infrastructure or in the capital goods sector. Uh, for this to pick up the growth, the GDP growth has to be big. It's for with a GDP growth of 4-5%, these companies are not going to grow 20-25%, and therefore many of the large investors are shying away from buying such stocks. So these stocks, especially stocks like NCC, are not falling a lot, but they are not bringing in the kind of returns as would a consumer durable or a FMCG or other companies in those sectors are doing. This is because the future prospects of earnings also look very grim. So there are options available in retail, in FMCG, in consumer durables, in consumer ancillary, even in autos. People are going in because they are more related to consumer spending rather than government spending. When you talk of HCC, NCC, GVK, GMR, or other companies, even BHEL, for which I made a video yesterday, you can go ahead and watch that video. When you talk of those companies, then it is the government spending that pushes the growth forward for these companies, and not the private capex or the consumer, you can say consumer rush towards shops would mean a lot for a company like NCC. It would be the spending from the government, for which the whole of the industry is still waiting. Let's see when that happens. So, what could be the reasons to avoid? And I still believe, even though it is a profitable company, it is not as bad as other companies in the sector, and the balance sheet is maintained well. I still say that at the moment you need to avoid, because you're not going to get a lot of appreciation in the next couple of years. The gestation period for projects are high, so these are projects run for 7, 8, 10 years. I mean, the hydel projects or the irrigation and power projects run for between 4 to 5 to 10 years, and then the profits come in, or the money from those projects come into the system. They are heavily dependent on high rate of GDP growth. As I explained, the GDP growth has to be 7% or to 8-9%, at least between 7 to 9% for the companies to do well, for these sorts of companies to do well, because then they'll get heavy projects, big projects, and the profitability would increase sufficiently. It is a very good company, but the sector itself is under stress. So yeah, take this into consideration. For example, you buy something like Motherson Sumi, but the auto industry is under duress, then even that won't move. I'm not saying that this is a kind of mother Sumi for the infrastructure sector. By no means I'm trying to say that, but you need to understand that first the sector needs to be favorable, and then you can look at these companies, yeah, as a whole. Let sentiment revive, let the numbers come in, and only then you'll be able to make money in this sector or in these companies. If you have if you have shares of NCC at higher price, say 70, 80, even at lower price, you need to hold on probably at least 2 to 3 years for your price to return. Your price would come back. I mean, if you have bought it at 75, 80, it would come back. But will it sustain or not? It all depends on when the government spending would increase in infrastructure, and they get more orders and the numbers turn around. So if your price come back, you're holding the stock, exit at that level if nothing on ground has changed. Otherwise, you need to hold on for the things to improve. So this was a video on NCC Limited, and I hope you like my video, and please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.